Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm pleased to have Rick Rule with me once again. Rick founded Global Resource Investments in 1993 and is now a director of Sprott, Inc. It's a Toronto-based investment manager, currently with about $10.6 billion in assets under management. Rick is also CEO and president of Sprott U.S. Holdings, where he leads a team of skilled earth science and financial professionals who enjoy worldwide reputation as resource investors. Rick has been very successful in the past because he is a very smart, independent thinker, and I have observed him as a man who has a very great people person and judge of character capability. It's hard to think of anyone with more of the traits and skills than Rick has to manage a company of substance like Sprott, especially at this time of enormous stress and strain on the global economy and on Americans and in general, the tough times that we're all facing in one way or another. Some having a much tougher time than yours truly, who sits behind a desk and behind a computer most of the time, sequestered in a house with Mrs. Taylor. But in any event, I'm so happy to have Rick with us. Thanks for joining me again, Rick.
Jay, it's always a pleasure. I love these visits.
It's always good to have you, I must say. You and the missus are okay, I take it?
Isolation suits me well, Jay. I'm lucky enough to have a very nice house to sequester in. Uh-huh. My wife of 30-something years and I still enjoy each other's company. So while my pleasure is diminished by an understanding of the hardship that billions of people are going through.
Yes.
My personal circumstance, particularly in comparison to everybody else's, could only be described as sublime.
Yeah. Well, I think I come pretty close to that as well, I must say, when you look at the people that have to go out there in the population to carry out their jobs and pay their rents. It's yes, we're very blessed. Rick, well, what is Sprott doing now? All of Sprott doing now to cope with this COVID-19 challenge?
Well, Jay, Sprott was built for this circumstance. We have a bulletproof, anti-fragile balance sheet. Mm-hmm. So the fact that capital is suddenly not available is of no consequence to us because we have plenty. We existed in industries that for the last 10 years have been very out of favor, natural resources and precious metals in particular. And suddenly, at least with regards to our precious metals franchise, we're the belle of the ball. For the last 10 years, most investors couldn't spell gold, but they're refreshing themselves on the subject very, very rapidly. We've gained about $1 billion in assets under management in the last few years. While most of our compatriots in financial services have witnessed massive outflows and massive declines in their values. So I have to say, we were sort of built for this. Through the bear market in resources and precious metals, Sprott invested consistently in building our franchise and in building out our human capacity. While other competitors were in fetal position, we were spending between $3.5 and $4 million a year growing our business. So we now manage money on behalf of over 220,000 investors worldwide in a range of financial products focused on natural resources and particularly on precious metals. So ironically, to sort of paraphrase your own headline, the world's hard time is paradoxically our good time. Mm-hmm.
Well, you've been known as a contrary investor, Rick. You've built your reputation by buying and seeing opportunities when everybody else is, as you say, curled up in a fetal position. And what do you think? I mean, where can we go right now? What should people be doing? I mean, talk to us a little bit about Sprott's, the whole Sprott, the Toronto Sprott as well as USA Sprott. What are some of the products that you have to offer? I know that you have some gold bullion, silver bullion ETFs, for example. Can those ETFs now, tell us about those, because we're hearing stories about the difficulty of people getting their hands on gold and actually being able to take possession of physical gold now. Is Sprott able to do that on behalf of its clients?
Yes, we have been buying between $20 and $50 million a day worth of physical bullion. That isn't to say that this is easy to do, but the physical shortage that is reported is mostly in retail product. That is mostly to say in very small sort of units.
Yeah.
Sprott normally buys London Bullion Market Exchange or Chicago Mercantile Exchange good delivery product, which is most frequently 400-ounce gold bars. Mm-hmm. There have been regional shortages of those products when New York has been short, London has had some, that sort of thing. Mm-hmm. But we've been able to circumvent those problems so far. Now, there are beginning to be tightness exhibited in those products as well. Because the three principal mints in the world, or refiners, pardon me, that make that stuff, as well as the Royal Canadian Mint, are currently shut down as a consequence of the coronavirus. We're told that the Royal Canadian Mint will start up in a couple of weeks with limited production, making institutional quality products rather than retail products. Mm-hmm. And we understand that the refiners are also looking to gear up. So it could be that the shortages that you see in the retail physical markets will begin to go away. Ironically, those shortages have inured to our benefit. When retail investors went to buy physical precious metals from the dealer communities and saw, for instance, that gold that was maybe $1,650 at spot was $2,200 for physical delivery, people began to turn to the Sprott physical products, which are trusts that trade on the New York Stock Exchange, and the incredible premiums that reflected the tightness in physical products are much less pronounced at the Sprott level. Mm-hmm. So we have been an odd beneficiary both of the increase in popularity of gold and silver, but also as a consequence of the fact that many retail people could not satisfy their demand for product in the physical markets and turned instead to us. It's worthy to note that those investors who are U.S. taxpayers may find that owning the Sprott physical trusts conveys a tax advantage to them rather than owning either the ETFs like GLD or the physical product itself. Mm-hmm. When one sells one's physical gold, if one does, if they sell it for a gain, the physical precious metal itself and the ETFs, which are physical sort of substitutes, mm-hmm. Are taxed at the collectibles level, while the Sprott trusts are taxed at the capital gains level. So if you live in a high-tax state like California or New York, mm-hmm. It might give you tax advantages to own the Sprott product, which is something that we think investors certainly have not lost sight of.
Mm-hmm. Are these Sprott trusts, are they for average investors or are they for upper income people?
No, they were designed for retail. Well, let me rephrase that. They were really designed for the personal account of Eric Sprott. But in the course of doing that, anybody who has a Sprott account or a Fidelity account or a Schwab account or an Interactive Brokers account can buy these things. They're New York Stock Exchange traded. Mm-hmm. So they're very accessible to small investors, even investors, frankly, who wouldn't want to buy an ounce of gold, but rather, in effect, would like to own half an ounce through the facilities of the New York Stock Exchange. They are extremely investor-friendly. That isn't to say that we don't have $25 and $50 million holders. We do. Mm-hmm. But the truth is that we manage metal on behalf of 220,000 retail investors worldwide.
Mm. So does it pretty much track the price of gold, the value of these trusts?
They do. One of the knocks against trusts is that historically they sold at a discount to the price of the precious metals, so they haven't tracked accurately. In our case, large investors can redeem their trust units for physical precious metals. Mm-hmm. So whenever the trusts begin to trade at a discount to the price of precious metals, arbitrageurs could short the metal, buy the trust, surrender the trust units, and then give the metal that they redeemed for to cover the short, which meant that the trusts actually very accurately track the underlying precious metals. They now sell at a very small premium to the precious metals, which we think reflects the tax advantages accorded to U.S. holders relative to owning the metal itself.
So you've seen some evidence of this arbitrage activity?
We haven't in recent times.
Yeah.
But going back sort of 2 years ago, sure, there was reasonable arbitrage activity in the trusts.
All right.
And while we didn't like losing assets, we certainly understood that the value proposition was that if the value of the trust didn't reflect the value of the metal, that the metal actually belonged to the unit holder, and it was their business what they did with it.
Well, and one of the things that investors want to be sure of is that there is actual metal behind their holdings, and that it isn't just a paper scam. I mean, I don't know to what extent this is a reality, but there's certainly fears among certain people in the markets, so the gold investors, gold bugs, that are worried that some paper products might not be all that straightforward and honest. But I think Sprott's products have had that reputation of being very forthright and very well protected in that regard.
Jay, these products were designed for the personal portfolio of Eric Sprott, whose name is on the door. And Eric wanted these products to reflect the fact that he didn't have much trust, either in government or Wall Street. He didn't want, in particular, to own an ETF where the assets would pinch and swell daily, and where some of the assets might consist of a deposit receipt from a financial institution that would go insolvent. In other words, he didn't want to end up as an unsecured creditor of Deutsche Bank or HSBC.
Right.
So in the case of our products, we can't hold delivery or deposit receipts. We can only hold physical precious metals.
Oh, good. Okay.
And furthermore, our gold and silver are held at the Royal Canadian Mint in a vault, not in third-party storage. Well, I have the same disregard for government that you do. The Royal Canadian Mint is debt-free, is profit-making. We are their largest tenant, and we joke internally that our security is provided by NATO.
All right. Well, NATO's good for something, that's for sure. All right. All right, Rick. Well, as given your reputation as an investor who sees opportunities when everybody else is overcome by gloom, what about the oil markets? You, in fact, have been known as a very astute investor in energy, oil and gas. And we're seeing, I guess maybe we've seen oil come off the bottom, natural gas also very low priced. Do you see opportunities in that area in the economy?
I do, Jay, but I think you need to look forward a year. I think another shoe may be due to fall in the energy markets. Well, really, frankly, two shoes. I'm not saying that the price will go lower particularly, but my fear is that when you see the impact of these commodity prices on the income statements and then the balance sheets of the public producers, that while some of the decline has been priced into the equities markets, I'm not sure all of it is. A different concern is the fact that the energy business is extremely capital intensive. And energy credit, and for that matter, energy equity, has gone from being hyper available to being unavailable. Further to that, and the next statement is speculative, Jay, but I've been told that 15% of the issuance of publicly traded non-investment grade debt in the United States, high yield or junk debt, is energy related. And as people become concerned about the ability of the energy companies to service and redeem this debt, In particular, because so much of this debt is held in high-yield ETFs, a circumstance that saw individual investors sell and redeem the highly liquid ETFs might see the managers of those ETFs trying to sell very illiquid assets to fund redemptions, which could have the impact of a run on the bank. A non-traditional bank, to be sure. But you're an old banker, Jay. I'm sure that your worst fear as a banker was a mismatch between assets and liabilities.
Oh, for sure. Yeah.
Which is precisely what these ETF managers have. So for myself, I would tell clients, and I have been telling clients, unless you are a really sophisticated oil and gas investor, these are markets to be avoided. I myself am tiptoeing into the markets by trying to buy senior secured revolving credit facilities from banks who are overexposed to energy, where the assets that secure the loans are very long-lived. But this is probably not a game for mortals. I'm a veteran energy lender, and I know a lot of the borrowers. The other thing I would say, Jay, is that while I see opportunity really truly across the spectrum in natural resources for the next 4 or 5 years, I think the action in the next 12 months is in precious metals. I think the policy response that the big thinkers are putting in place as a consequence, by big thinkers, as you know, I'm being facetious, referring to governments. The policy responses that the big thinkers are putting in place as a consequence of an economic slowdown and the virus are just tailor-made, pardon the pun, for precious metals. Quantitative easing is a fancy way of saying counterfeiting. You're debasing the currency. One defense is gold. Artificially low interest rates reduce the premium associated with the risk that one receives for lending money to the government. The big competitor to gold in the last 40 years, I would suggest to you, has been the U.S. 10-year Treasury.
Sure.
The U.S. 10-year Treasury has been characterized by our mutual friend Jim Grant as return-free risk.
Yes.
So the competition that gold has to face from return-free risk is not very stout. The consequence of the fact that I'm still bullish about the outlook for precious metals prices means I need to become increasingly optimistic about the price performance or potential price performance of gold-related equities, because the recent strength in gold has not been reflected in the equities markets. This is traditional. It's happened in every gold rally that I've seen for the last 40 years. Gold moves first because it moves on fear. When the increase in the gold price becomes reflected in the operating margins on the gold producers' income statements, and in turn begins to improve the balance sheets, then the gold mining companies do well. And Jay, when I say they do well, I have a chart which I'm happy to distribute to your listeners.
Yes.
Barron's Gold Mining Index chart. It goes back about 50 years. And I'm not a technical analyst, as you know. I'm a credit guy. But the chart is a useful illustration. There have been 8 recoveries from oversold bottoms over the last 45 years. And these recoveries have varied in intensity to the upside between about 180% and 1,200%.
Wow. Yeah.
Over times as short as 13 or 14 months and as long as 42 months. So if past is prologue, and if we are into a gold and later gold equities bull market, which I think we are, the upside, the as yet unreflected upside in the gold equities is really extraordinary. I'm not saying that one should go out and sell all of their financial assets and buy gold stocks. What I am trying to say is that almost everybody in the world, including many of our clients and many of your listeners, are ironically underinvested in gold, and they need to address that, and soon.
Soon, more now than in other times, I would suppose. I mean, you're obviously for obvious reasons.
Well, you and I are credit guys. We're not economists, but you look at a situation where our government in very recent times has talked about $4 trillion in counterfeiting, and where there's popular demand for much more, that's much more likely than not to be beneficial for the gold price.
Indeed. Rick, just with about 3.5 minutes or so left here, Sprott recently acquired the Tocqueville Gold Fund. I've been following them for many years. My friend, I actually worked with Doug Rowe in the past at ING Barings for a little while. I have known John Hathaway for a number of years. These are really great people. What are you seeing and what are they seeing in terms of the virus, in terms of the production capacities of the producers, the gold producers?
Right now, about 2.5% of global production in the gold side has been shut in.
Only.
And we expect this to be at least a 2.5 month problem.
Uh-huh.
The mills are usually able to continue to produce on skeleton staffs.
Uh-huh.
We think that the production decline may continue, although there's no way of knowing. By the way, Grow and Hathaway are just absolutely superior human beings. I couldn't be happier to have them as new partners. We've competed with John Hathaway for 30 years, and I'll tell you, I'd much rather cooperate with him than compete with him. He's a truly superior human being.
Yeah,
it's just delightful. An example of how out of favor gold was when the Tocqueville mutual funds were sort of disbanded. They couldn't find a taker for the gold franchise. Nobody wanted it. And for us, it was like, welcoming home the prodigal sons. It was just wonderful.
Indeed. Not really prodigal. Those are pretty good guys. But prodigal from your old position, perhaps. Yes, I understand. Well, they've come home, and they're really great people for sure. I've known them for years. And so I find that that's very optimistic. I mean, it seems to me, you said, if I heard you right, Rick, 2.5% production decline. Would that be for this quarter, perhaps?
Yeah, well, facilities representing 2.5% of world production, total world production, have been shut down.
Yeah. Okay, well,
that may expand. I'm frankly amazed that the deep South African mines are open, but they are.
Mm-hmm. Oh, yeah, I wouldn't. I don't think I would want to be down there in the bowels of the earth with COVID lingering.
In the best circumstances.
In the best circumstances, yes, indeed. Well, and then I think Rick, we should start to see some probably pretty soon. Start to see some of these gold miners reporting their earnings, huh?
I think that's right. And if I may, with your permission, offer your listeners a service around that.
Absolutely.
For J. Taylor listeners, if you will email me personally, the email address is rankings, rankings, at sprottglobal.com. In the text of the email, put your natural resource portfolios, names and symbols. I will rank those companies 1 to 10, 1 being best, 10 being worst, and comment on those companies where I think that my comments have value.
Wow.
In addition, I will send you in return email the Barron's 50-year gold mining index chart, which is a wonderful illustration of where these equities are in a historical sense. And I will also email a 100-year commodity chart, which will show the relative valuations of the commodity complex.
No, that's tremendous.
None of this should be interpreted as investment advice, because I don't know most of your listeners. This is purely for illustrative purposes.
Okay.
But if you email me at rankings, names and symbols in the text, I will email you back the company rankings as well as the 2 charts mentioned. I think this is a wonderful time to begin to pay extraordinary attention, in particular to your precious metals equities portfolios.
Excellent. Thank you so much for that, Rick. It's rankings at sprottglobal.com. Excellent.
Yep.
Thank you so much for that, Rick. All the best to you.
Pleasure, Jay. Thank you.